Should I start? Okay, good morning to our members across North America and a very warm good evening to our colleagues joining us from India. Welcome to today's webinar, a unified discourse in North America on immigration, and tax strategy. This event is a collaborative effort between the members in Industry and Business Committee and the ICAI Chapter of Michigan in USA. Our professionals in the global economy, the movement of talent across the borders is frequent than ever, and yet it brings a complex web of reporting, compliance, and regulatory challenges. Today, we aim to demystify these dynamics. We have three speakers on the panel: CA Siddharth Goyal, CA Kulwinder Makkar, CA Rajiv Ahuja. Now, I would like to introduce Dr. Anuj Goyal. He is the chairman of Members in Industry and Business Committee. A brief intro. He is a Central Council member of ICAI, chairman of the Members in Industry and Business Committee, with over 30 years of professional experience, holding multiple qualifications, including the Chartered Accountant, Company Secretary, CMA, LLB, MCOM, PhD, DISA, and DIM. He has served in various leadership roles across ICAI and contributed extensively to research, publications, and professional development initiatives. Now, I would like to invite CA Dr. Anuj Goyal, Chairman, to deliver the keynote address and start the discourse. Thank you.
Thank you very much, CA Siddharth Goyal ji, our honorable, very prominent chartered accountant and the moderator of today's very important webinar on the topic Unified Disclosure in North America on immigration and tax strategy for members in industry and business. I'm really very happy that we are having very prominent persons with us. We are having Advocate CA Rajiv Ahuja ji from India. We are having Siddharth Goyal ji, very prominent chartered accountant from industry. And of course, we are having the presence of CA Kulwinder Makkar ji, our very prominent resource person today, who is having the experience of working with the Big Four also. And of course, we are having the presence of the most important lady, the chairperson of the Michigan chapter of the Institute of Chartered Accountants of India. And of course, the architect of this program, the secretary of Committee for Members in Industry and Business, CA Michigan, and all the respected delegates who are with us from each and every part of the country and outside. I'm really very happy that in spite of the time difference, we all are on the same page from the different parts of the globe. And as the Institute of Chartered Accountants of India is having the global presence, our 50,000 plus chartered accountants are contributing for the cause of the profession, for the cause of the nation from the different parts of the world. And more particularly, they are working in industry. So I'm really very happy that I got the responsibility to chair this very important committee for the second consecutive year, the Committee for Members in Industry and Business. And friends, at present, close to 3 lakh chartered accountants, 300,000 chartered accountants are the part of the industry and business. And I'm really very happy that today we are having this webinar in collaboration with Michigan Chapter. And we are trying to see that every week we can outreach to our members and through webinars also. We intend to have the physical programs also in other parts of the world, and we certainly like to see how we can reach out to the members of the Michigan physically in the times to come. And the today's program, the North America landscape, this is the fourth in the North American landscape. And the theme of today's discourse is unified disclosure in North America on immigration, and tax strategy. I think it is very, very important. And as Indian CAs increasingly take up pivotal role in the US and Canada, understanding the intersection of mobility and fiscal responsibility is paramount. And we are moving beyond simple compliance into the realm of unified disclosure, where domestic regulations meet international tax treaties, navigating the nuances of residency status, cross-border tax implications, and strategic wealth preservation requires a sophisticated approach. And this webinar aims to provide you with the clarity needed to manage these transactions seamlessly, ensuring that your financial statements are as global as your career. And I'm quite confident that when we are having the best of the resource persons, I think we will be more knowledgeable and more clearer in our knowledge as far as this particular topic is concerned. And I will request, I will urge all our honorable members in other parts of the world also that we are having very, very prominent initiative of ICAI to have the industrial CP study circles. Purnima ji, we can have the industrial CP study circles everywhere in the world, where in an organization more than 20-25 members are there, we can have the industrial CP study circle. And those industrial CP study circle can be there in USA, can be there in Canada, can be there in the Gulf countries also. And those industrial CP study circles are eligible to do the CP programs, physical as well as virtual, with the help and support of the Institute of Chartered Accountants of India Committee for Members in Industry and Business. And through that, we will be having our presence of the Institute of Chartered Accountants of India in that particular company, in that particular organization, in that particular industry. So I will urge to all our delegates to ensure that if we can have our CP study circle in your organizations, we will be there to help you out. Anita, you send all those details to the Michigan chapters also and all the delegates who are joining us today, because we will be having all the details with us. We are already having more than 150 CP study circle, and we look forward that how we can reach maybe close to 1,000 CP study circles by the end of this year. And in addition to that, we must be very, very aware that we are having ICAI awards in which we do recognize the most prominent chartered accountants who have done very good in the field of industry and business. So very soon we will be launching all the details for the ICAI awards. And in addition to that, we have taken one very, very good initiative for the young chartered accountants, 40 under 40 awards. We identified 40 young chartered accountants up to the age of 40 years who have done exemplary well in the trade and industry. Evening itself by the president of ICAI, Prasanna Kumar T, sir, and from 6th of May, that portal will be open, and the members who are up to the age of 14 years can apply for the 40 under 50 awards for this year. So I will not be taking your further time. It's been very, very eager to have the panel discussion led by Advocate Sri Rajiv Ahuja, Siddhant Goyalji, and Mr. Makkar. And I'm really grateful to Siddhant Goyalji also, who is very, very active in the business chapter. And of course, the Purnima ji, who is the dynamic chairperson of the Michigan chapter. and of course Anita Sunija ji, who tried to see that in a very, very short span of time, we can organize this webinar. I will request all our honorable delegates to be attentive and raise as many edge queries which are possible. And I will request our honorable panelists to address all the queries. So over to Siddhant. Thank you very much.
Thank you, Dr. Goel. We are now moving to the main segment. And so before we go there, a short introduction for our eminent panel. So starting with CA Kulvinder Makkar. So besides being an Indian chartered accountant, he's a CPA from US, CPA from Canada, and is a director at International Tax Advisors Canada, specializing in international tax and transfer pricing, with prior experience at Big Four firms, Ernst & Young, Deloitte, and RBC and PwC. Moving on to the introduction for CA Siddharth Goel. He's a chartered accountant and a law graduate, holding tax function as heading the tax function at the DS Group, with expertise in domestic and international taxation, and an active contributor to the industry tax committees. Moving on to Mr. Ahuja, Mr. Rajiv Ahuja. He's a chartered accountant as well as law graduate, and is a managing partner at Synergy Lex, New Delhi, with over 2 decades of experience in taxation and litigation, and speaks regularly on direct taxation and Benami law. So let's begin with segment 1, so which is on immigration and immigration dynamics. So I'm moving on to CA Kulvinder Makkar. So Kulvinder, let's start with the basics of the move when a person who was living in India relocates to either USA or Canada. What are the key tax triggers at the entry, especially regarding asset declaration, etc., they have to do? You are unmuted, actually. You have to unmute. Sure. I think that, yeah, can you unmute?
Okay, yeah. Okay, everybody is able to hear me?
Yes.
Thank you, Siddhant Goel, and thank you, CA Dr. Anul Goel ji and Purnima ji, for giving this opportunity to be presenting on this seminar. So yes, Siddhant, that's an interesting question. Because when our fellow professionals from India, they move to Canada, move to US or Canada, or any other person who moves to US or Canada. So besides their planning for which state or which city to reside in, which schools for their kids, an interesting portion is planning about the tax implications as well, and which I as a professional, I've seen a lot of people, they come to us only at the time when they have to file their tax returns. And they have never thought of the tax implications or tax filing requirements they have to do when they move into a new country. So your question actually has 2 aspects. One is disclosure, as you said, at the time of entry into US or Canada. That's where probably the immigration guys or the customs people would be the first ones where you have to make some declaration of the cash or other valuables that you're carrying with you. I strongly recommend you must do it, because when you bring in cash over $10,000 and you at some point deposit it in the bank accounts, CRA or IRS would ask you a question where this cash has come from. So if you have made the declaration at the point of entry, this will help you to answer those questions. Secondly, very important is that in case you're coming into Canada or US and you have some valuables, some personal belongings which have to follow later on, you must declare those as well, because you don't want to be paying customs duties later on when you want to bring in those valuables. Now we come to the main section where we have to do the tax disclosures or tax compliances. So we'll start with USA, and then we'll quickly touch upon Canada as well. So under the US tax regulations, the disclosure of foreign financial and non-financial assets is mandatory. If you are a US citizen, a green card holder, or you move from India and you have a substantial presence in the country. Substantial presence is like if you exceed 183 days in the US, then you have to make disclosures with respect to your worldwide assets and your worldwide income as well. So the first one is what we call FBAR, which is Foreign Bank and Financial Accounts Reporting. This is under the treasury regulations. It is not strictly under as per the IRS regulations. So, but it is a mandatory filing that you have to do every year. The date coincides with your tax return filing dates. And this triggers in case you have a balance of over 10,000 USD in your bank accounts, which could be savings bank account or mutual funds. Even you must remember that even EPF or PPF, if you have those investments in India, it's mandatory that you make a disclosure. And one most important thing is that if you have life insurance policies which has a surrender value, not your term insurance, but if you have a life insurance with a surrender value of $10,000, which we've seen in our experience, a lot of people miss that. So that is mandatory, and you don't want to be making a incorrect filing because there are penalties attached to it. Second important filing, Siddhant, is that there is a form called Form 8938, which comes under what we generally call as FATCA, FATCA, Foreign Account Tax Compliance Act, which is very similar to FBAR, but this is regulated by IRS. And you have to make similar disclosures. The only thing is that the threshold for making a FATCA reporting is higher than FBAR. So if you have assets, so there is a range actually, and that range depends on your filing status. So if you are filing as an individual present within the US and you have assets worth $50,000 or more in India, then you have to make a disclosure. But if you, and on the other side of the range is if you are married and filing jointly, you're living outside of US, but still being a US citizen or US green card holder, then the threshold is 600,000. So that's a huge, big threshold. You may not get covered within that. So that is, if you fall within that range, then you have to do this reporting. This is the only additional part as compared to FBAR is that when you're doing a FATCA reporting, in case you are holding any shares directly, not through your bank or not through a mutual fund, you have to report that as well, which is not there in the case of FBAR. The third one, which is in case some of you, like as an entrepreneur, moves into the US, there is a form called 5471, which has to be filed if you have shares in any Indian company of a value of more than 10% of the total share capital. Or you have a control. The last one, which is the most important one, especially, and we get a lot of questions on this, is that in case you are having some mutual funds, SIP, ETFs in India, and those fall within a definition in the US, which is called passive foreign investment company. Because these companies, like mutual fund companies, if they have income of more than 75% coming in from passive sources, so you have to make this reporting, and this is the toughest one. I don't know if the right time to add this, but usually we recommend our clients, in case they have mutual funds or ETFs, then they should actually sell off these before they come into the US, because there are high marginal tax rates for any income that you earn out of mutual funds or ETFs. The disclosure requirements are very stringent. And if somebody moves from Canada to the US, then our TFSA falls within this definition. So if you have a TFSA investment, you must make sure that you adequately discuss it with your tax consultant and have some plans for how you want to disclose this on your tax returns. Failure to file this PFIC form has a penalty of $10,000. So now we move to Canada, and please feel free to ask questions. I know because of the time, I may be going a little faster. Yes.
Kulwinder, just one follow-up question came from the audience. They're saying if there is because you're moving to Canada, so just for the America side first, So tax liability on American citizen receiving funds as per will from Indian parents. Okay. Will it be different if will is made in the name of grandchildren holding American passports?
So it'll again depend on the filing status, Siddhant, on if they are filing, the grandchildren, I'm assuming, have a Canadian, have a US passport. That's what you said, right?
Yes, correct.
Yeah. So now we are covering this in a later section, but just as a brief, quick answer. So if if they are filing their tax return in the US as a US tax resident, then whatever money they get in receive as a will from their parents as a gift would actually and it is because of a sale of property or something. That's what you said. I'm so sorry. I'm just trying to kind of clarify because there are different aspects to this question.
Yes, of course.
So if that is because of sale of property, and the sale of the property was under the name of the grandparents, so that money would be a tax-free money in the US.
Okay, thank you.
Okay.
So yeah, so you can move to the next section, or
Canada again is a part of this answer. So once you are in Canada and there is you become a factual resident based on the number of days. Canada is a simpler one. You need to do one form which is called T1135, which triggers in if there is investments or money that you have in India over 100,000 Canadian dollars. So you have to report that. Just that $100,000 does not include any personal belongings. In case you have one home, which is defined as your primary residence, then you don't have to disclose that. You don't have to disclose your personal property like jewelry or anything else. But any amounts in your bank account, any mutual funds, insurance, that has to be disclosed. There is a penalty for non-disclosure. And T1134 is equivalent of Form 5471, where if you have investments in a company in India of more than 10%, then you need to report that on your T1134.
okay, so just on the flip side, when leaving US Canada, how does deemed disposal of exit taxation work? Just a brief answer before I move to next.
Sure. Okay. Yes. Again, an interesting one, and that's where when I said I will touch upon this thing. So, if you are a U.S. Citizen, a green card holder, or having a substantial presence in the U.S., then you have the choice. You want to continue with that, then your worldwide income keeps being taxed in the US, and you keep filing your US tax returns. And which is mostly the case. Almost 90% of the people that come to us have such situation where they don't want to give up on their US tax residency. But of the other few who want to actually give up on their green cards or give up on their citizenship, which is rare, but just hypothetically, if they do, then there is something called the exit tax. So you have to file a tax return, the final tax return at the time you leave US, and you value your assets which you have and on a fair market value, and you have to pay taxes on that. So this is significant because you have not sold the assets, but you moved out of the US, and there is an immediate tax liability. There are certain ways which where you can actually defer this tax liability, but that is by filing surety or by filing a bond with the IRS. So
thank you, Kulvinder. Yeah,
okay, thanks.
Yeah, so there are a lot of questions coming actually. So what I recommend is we are collecting those questions, and we will do the Q&A session, and we'll bring that because there are like a lot of list of long questions coming up. So sorry, we need to do the time management a little bit here. So movement is not. Thank you very much for your insights and all the great information. So now movement is not clearly just physical, right? Once we are moving, it creates a continuous reporting obligation. So now let's look at the compliance backbone that supports this movement. So moving on to the segment 2, which is about the non-resident tax compliance and funds flow. So I would like to address CA Siddharth Goyal. So Siddharth, once an individual is settled and becomes a non-resident in either US or Canada, what core tax compliances must they maintain back in India?
First of all, I thanks to ICAI Michigan Chapter to take us in the panel, and then Dr. Anuj Goel, who is a good friend of mine also, as well as he's a super gentleman and the thorough ornament for the institute. Coming to the topic which you raised, see, you all must be, there would be some wondering which is going on all over the world, including India mainly, that Income Tax Act 1961 has been replaced with Income Tax Act 2025. So just to throw, before coming to your question, I just want to give you the brief background about that act. So there is no substantial change per se in the provisions. New act is not imposing any extra taxes, nor they are taking any relief out of it. It is the same, but it is in a lucid language. They have reduced the redundant sections which are not applicable. Residency concept is also same, which was in 1961. So as far as the question coming to you, in case of NRI, if you have to compute the non-resident status, the method of computing the non-resident and resident rules are the same. The only thing is the sections has been replaced. Like coincidentally, the section 6 is the same for computing the residency in 1961 as well as in 2025. Now coming to your question, which you asked, like the people who leaves India becomes non-resident, and what are the compliances which they need to ensure in India. See, in India, if there are the threshold limits, as you all Indians also aware, the person who is going from India to outside world, there are two tax schemes which going on. One is the new tax regime and the old tax regime. Under new tax regime, the minimum exemption taxation limit is 4 lakh rupees, whereas in the old one, it is 2.5 lakh. Why I pointed out these limits is the point, if the person who is intent to left India for outside settlement and he becomes non-resident for the year, if he is earning any income which arise out of India, like interest income, like dividend income from some stocks he invested, like some capital gain if he sells some sort of shares and all that which he invested in India, like he's having some rental incomes. If the computation of the all aggregation of those incomes crossing 2.5 lakh or it is exceeding 4 lakhs if you want to go for new regime, then he's supposed to file a ITR in India as per the rules and regulations of India. The caution which I would like to point it out is with reference to person who are leaving India, they should ensure that in the past, there should not be any pending litigations in hand. They should clear those litigations or either deposit those taxes under protest, and they can continue litigating from outside world also. There is no issue at all. But they should properly handle those litigations which has been left behind in India. For example, somebody is planning to leave India in 2026 and he is having some tax liability of 2022 year which is in pending. Nobody can stop you for going out, but if it is a substantial amount, there may be chances authorities impose you not to pass on the country. So one has to take a caution that the past accounts also should be clear, and in continuity, they should continue to maintain those things. That is the compliance is another compliance part. Maybe Mr. Rajiv will also touch upon. After under FEMA, certain period of time, you cannot maintain a bank accounts in India as a saving or current account. You need to convert it into NRE, NRO or something, or you have to intimate. Under FEMA, it is the residency is based upon the intent of the person. Whereas in case of our tax laws, it is based upon the residency of the period it stays in that country. So the major difference is one can take a call after a year also when he thinks, now my intent, I am clear, I am settling down outside India, then he should, within the stipulated period of time, he should convert into his bank accounts into other things. Why I am asking is because there are certain laws in India like Benami, which maybe Rajiv must be touching upon in his session. So these are the important points which compliance is, are important.
Okay, so there's a follow-up question also. So what happens a lot of times, people both in US and Canada, once they move, after some time they would like to buy a property and they sell a property in India and then they remit the money here. So there's a lot of confusion on account of TDS, on account of the compliances at that part and bringing the money safely and legally to US. So can you throw some light on that?
Yeah, it's a nice question which you raised, and the main problem which was there since 1st April 26 prior to that is majorly for the buyer who is purchasing the property from a non-resident. Normally, the persons used to be individual, and there are TDS provisions are applicable on making the payment to a person in case of if a individual person purchase any property in India from an Indian resident, then only he required to deduct only 1% TDS. Whereas if he takes it from non-resident, he need to deduct the TDS at a rate of 12.5% or 30%, depending. I will coming upon how the rate comes to be. Why I'm saying after 1/4/26, the easiness government has given is earlier the buyer used to take the TAN number, tax account number they have to obtain from the authorities. Then after obtaining that, they have to deduct the TDS. That's why many times non-resident people got negotiated with the deal transaction value because of these compliances issues. Normally, the buyer avoid the transaction with the non-resident because they have to undergo unnecessary compliance of obtaining TAN, then do the compliances. They have a fear what will happen to us or some demand can come of a non-resident to us. So this has been gone away from this budget. They have given the similar method which is available for deduction of taxes based upon PAN of the buyer resident. They no need to take any separate TAN for doing this needful or one transaction. Now coming to the rates of taxation, there is no issue at all. Non-resident, if he's holding the property for more than 24 months, the tax would be withhold 12.5% plus a charge and all. Plus, there would be the catch here is the 12.5% would be on the gross amount. The non-resident, what can he do is he can apply for lower deduction of tax under Section 393 provisions. Earlier it was 195, wherein they can do it online. He no need to visit in India for applying that lower deduction. Based upon the submission of his estimated capital gain workings and other incomes, he can apply for reduction in taxes, and the tax rates has been reduced so that he no need to go for the refund situation after the selling of the property. That is the flexibility which the government has given, and it's a good move from the India government.
Okay, thank you, Siddharthji. So considering the time management also, and there are a lot of questions coming, so we are collecting all those questions, everyone. So we are going to, once we are going through the discourse sessions and segments, then we will bring the questions to the speakers and address those.
Sure,
so compliance, thank you. So compliance is becoming an increasing system driven. So however, the real complexity really arises in the interpretation of law and the risk of litigation. So with that note, let's bring in Rajiv Ahuja. So Rajiv, could you please walk us through the FEMA regulations and which often professionals, even qualified professionals, overlook, specifically regarding resident versus non-resident classification and so on?
Thank you. Good morning and good evening to the chairman, CMIB, Institute of Chartered Accountants of India, Anuj Goyalji, a good friend of all of us, the esteemed panelists and distinguished members joining us across geographies. Siddhant, this is a critical area because most of us or most of the persons assume that once they physically move, their regulatory status automatically changes, which is not entirely accurate. From the FEMA perspective, the classification of resident versus non-resident is not purely based upon the number of days you are present or your tax residency status or your passport status. It hinges on the intention to stay outside India for an uncertain period or for employment outside India or for purpose of the business outside India. Where we people go wrong is we continue to operate Indian bank accounts. We do not update our KYC status that as per FEMA we have become a non-resident. because your intention to stay outside India is uncertain. So that's the one area. Failure to update the KYC in the Indian accounts, the investments, or even business interest. As we still consider, because our intention is still to as a resident. Once you try to return India for within a certain period of time, you still continue as a resident. What happens is if you did not update your KYC status, for example, you are resident for the purpose of FEMA, but you are staying outside India because your intention is not uncertain. It's certain that you will come after 2 years or 1 year, or you're not left for the purpose of employment. Like many people are going as a student, so they have the fixed tenure. They have not moved out for the purpose of employment and business. So in that situation, what happens? They continue to make remittances outside India. They keep investing. They're treating themselves as a non-resident, and they use the LRS option. That's a critical point here. Using the LRS and you are still a resident or non-resident, very, very critical aspect. Because once you are non-resident, then only you are not eligible for any LRS schemes. So that's one area, which is a very critical area, to define your residency based upon your intention first, not number of days. The second aspect is your investments outside India. You are there, but for the FEMA purpose, you are resident in India, like a student. I'll give you an example. You keep investing in the foreign accounts and you fail to disclose. The second aspect is, we know in taxation, you should be a resident in any of the country. Your income, whatever you are earning, either should be taxed as resident or a non-resident in any country in the world. And your status should be a resident somewhere. So that's the aspect. Another aspect, fail to disclose your foreign assets in India. People travel to outside India, open the bank accounts, but when they become the resident from tax perspective, they fail to disclose it in their tax returns. It's very important that there is a disconnect between FEMA status and income tax status. You can be still triggered tax residency, but you are resident for the purpose of FEMA. LRS does not apply to you. FEMA is purely intention driven. Misalignment creates downstream compliance and litigation exposure. We are seeing it now because of AI augmented information analytics. They are detectable due to various treaties like FATCA with US. Now they are reported. India AIS Annual Information System report is analyzing it, and now the notices are issued very frequently. So that's a critical aspect for purpose of classification of resident and non-resident from the perspective of FEMA and tax. Another aspect which I will continue, my friend Siddhant has left on me. I just want to add one more thing. Although my taxable income in India may be less, not touching up the threshold, but if I am having it tax deducted at source on my various accounts, I am still eligible to claim that amount as a refund. Don't leave your hard-earned money, which has been deducted at a higher rate, because taxes for non-resident taxes not deducted at the prescribed rate. It is deducted from the maximum marginal rate. So ensure to file your returns and claim the refunds.
Perfect. Thank you. So there's one more thing which comes, for our CAs in the industry, is what are the risks in giving or receiving this informal advices to the colleagues on various subject matter, because that's very common, unfortunately.
That's true, Siddhant. Informal advice is really a pinpoint here, very important point. Everybody take the informal advice. Any advice which is not supported by an engagement letter, it cannot be a structured advice, number one. Number two, it should not be relied upon. Why we say so? If you have, especially in US, Kulvinder can second with me, that if your tax positions are based upon the legal advices, then it reduces the penalty exposure. But the advisory should be structured, It should cover all the perspectives from the legal standpoint. So people, what we have seen is in the litigation, people come up with a WhatsApp message and they say that we have acted upon this advice given by my colleague, which does not backed up by the engagement letter, and that advice is not structured. It does not cover all the legal points in that. It increases the exposure. The objective of legal advice is to back up the exposure at the time of litigation. Kulvinder can second with me. In US and even in India, we have the
even in India also.
It's a 200% penalties here in India. So, but if you have acted upon and structured advice, you can defend your position first. Secondly, you can show your bona fide to the authorities that this is the reason behind it. So that's why I would suggest and recommend to everybody that avoid the informal advices, go for the structural advices.
Perfect. Thank you. So that leads me into, because my inbox is flooded now with so many questions across the world. So let me quickly share my screen just to put it attention and start the Q&A session, actually. I'm just sharing my screen, everyone. It is just giving some background and details about the moderator and speakers. But however, coming to the questions now. So starting with Kulvinderji. So one question came from the attendees: how to start practice of US taxation market? So that's the question, actually. How do we start practice? Somebody wants to start a practice in US for taxation. How do we do that?
Absolutely, that's a good question, and we encourage, because we Indian Chartered Accountants are going global. We are very, our tax, in fact, the training that we have during our CA days and our curriculum really equips us to handle taxation or advisory matters for other countries as well, with some bit of reading. But unfortunately for the tax practice, I mean, for other practices, like if you want to do accounting or advisory, there is absolutely no restriction. But for tax practice, there are some restrictions. IRS actually has law which does not allow the taxpayers' information to go across the US borders. There are some exceptions where you have to apply to the IRS that you have an office or a back office in India, where you want to do the tax returns, but you have to make sure that one is IRS and the other is your clients. They know that the data would be shared across the jurisdiction. But then comes the main question: IRS does not support e-filing. So if you plan to do taxation and file tax returns for your clients in India, you can do it. There is there is something called PTIN, that is a Preparer's Tax Identification Number, which IRS issues to every person who fits into that, who complies with the conditions. That can be issued, but there is another form, number which is called EFIN number, which unfortunately they do not issue to any person outside of the US. So if you do the tax returns, absolutely you can do it, but you have to make arrangements to file tax returns through mail, through post. So that if you're okay with that, if your clients are okay with that, I strongly encourage, yes, this is a good revenue opportunity for all of our Indian Chartered Accountants, because the tax rates are significant. The fees are significantly higher in the US for that work. And that definitely gives a global edge to our chartered accountants. One other thing that you can probably do is to tie up with a US tax office, US tax filer, US tax practitioner, who has an EFIN number. So you can prepare the tax returns using your PTIN, which can be issued to anyone in globally. You don't have to be physically present in the US. So if you apply for that and you have it, you set up with a US tax practitioner, and you can e-file the tax returns using their EFIN number. I hope that answers. If there is a follow-up, I'll be happy to discuss it in more details.
Sure, thank you. So next question I'm going to ask is to C. Siddharth Goel. So what tax compliance is required to ensure if one plans to buy a property, especially land in India, and is a green card holder in USA?
If a person who is a green card holder can purchase land in India, but in case if he becomes a citizen of other country, and if he loses the citizenship of India, he cannot buy agricultural land. There is a ban of purchasing agricultural land by a non-resident who is not a citizen of India. Being citizen of India, he can buy, but if he is a green card holder but not a citizen of India, he cannot buy agricultural land, but other lands he can buy, industrial land and all, or based upon the RBI compliances, FEMA rules, how much amount which Rajiv can add upon. That is
Just to add here, Siddharth,
Sure.
green card holder is considered as a non-resident Indian, and any non-resident from the perspective of FEMA, whether he's a citizen or not a citizen, can be permitted only to buy a residential or a commercial property. A non-resident, whether it's Indian or outside, not an Indian, cannot buy a agricultural land or a farmhouse or a plantation. Secondly, he must ensure that the payment should be made from NRE or NRO account or FCNR account. He can, because a non-resident cannot maintain any other account in India, or a direct payment from outside India through a banking channel. No cash or informal funding is permitted for non-residents. And apart from that, and as per Income Tax Act, any payment of more than 20,000 for purchase of property is not allowed, whether it's a resident or a non-resident.
in cash.
The most important is, I would suggest Mr. Kulvinder to add his comment here, that once a person resident of US buys a property in India, what the compliances he has to make in US, because he is holding a foreign assets. That is also very
FBAR,
important. You
I think
cannot
FBAR reporting and all
ignore,
that.
because from the
Without-
AI's perspective, that item, that purchase and that transaction, it would be reported and exchanged between the two countries.
Yeah. Like in India, for a resident,
Like in
he has
India.
to disclose
Like in India.
foreign assets.
Yes.
Similarly, as you mentioned in Canada, there is a rule, but what about in US? Rajiv is asking that.
Kulvinder ji.
So there are two things. One, of course, is a disclosure, which has to be done under FATCA. So if the moment you buy a property in India, whether it's a a residential property or a commercial property, you have to disclose that on your form 8938. But at the same time, when you sell it, and if you sell it on a profit or a loss, since your worldwide income gets taxed in the US, so or in Canada as well, similar rules are there in Canada as well. So you have to report those capital gains or capital losses on your tax returns as well.
Okay, so there's another interesting question I just got. How much Indian rupees in cash and in bank can a non-resident Indian hold?
Okay,
Is there
so
any
if this
capping
question
or
is from
limit?
yeah.
Yeah.
If this question is from a US perspective or a Canadian perspective, and I can answer, otherwise I'll request Rajiv or Siddharth to answer it. From a US perspective, there is no such limit. It just has to be legally earned and also reported on on your FBAR or FATCA. But there is no limit. If you earned that amount while you were in the US, then as a part of your worldwide income, you should have paid taxes on that. But if you have earned that income before you enter US or Canada on an immigration, and you have it, just report it, and that's all that you have to do.
Same applies to here in India. A non-resident Indian, a non-resident from who is a non-resident from FEMA perspective, can hold any amount in Indian bank accounts. But he should
Provided they are
ensure that
NRI and
the
RO.
account should not be a resident account. It should be NRO or FCNR or NRE account. So now, because FEMA permits to hold the bank balance only in the accounts which are there, so non-resident is not permitted to have a very huge sum of cash in India. It can be only 10,000 rupees permitted to be held in India, which you come here and need to declare at the airport at what is the source of that amount.
Okay, there's one more question which came. So they're asking, is LRS not allowed for non-resident? And I believe LRS means liberalized remittance scheme. So that's my only FEMA question, I believe.
Let me handle it. The LRS scheme, liberalized remittance scheme, is brought somewhere around 15 years back. It's for the purpose of capital investments by the resident outside India. And this is only for the residents. A non-resident is not permitted to remit the money under LRS. It's a limit for LRS is $250,000 per year, per financial year, which start from April 1 to 31st March next year. Its purpose is education, marriage, gift, investments. It's a permitted. This is fully repatriable. You cannot invest this money, which cannot be repatriated back to India. It need to be ensured while remitting money by the residents that it should be repatriatable. Only to be invested in such instruments which are permitted by the respective investee country to be remitted back to India.
Okay,
next,
thank you. Yeah, so the next question is how it's not a clarification here. Okay, so what is the procedure to get the PTIN number, and any advice on how we can identify the tax offices in US? I think Kulvinderji, this is for you.
Okay, so
yeah.
Yeah. So thank you, Siddhant. PTIN is not based on you need to be a CPA or a enrolled agent, which is called EA. It depends actually based on the number of years of experience that you have doing US taxes. IRS has a questionnaire which you need to answer at the time of requesting a PTIN. PTIN application is an online process. You can just easily Google and get the link for IRS PTIN application. So that's not, I mean, that's not difficult, and they rather encourage that people across the world they apply and get PTINs because that will help the expatriates, the US expats, to be able to get their tax returns filed wherever they are. But yes, the second question is how to get get hold of a US tax office who's able to share the EFIN number. That is something which is more, you have to make personal efforts, reach out to people on maybe LinkedIn, find out, not everyone would agree to your, filing to giving their EFIN because there is a associated risk. But there are people who are not able to manage their workload and who want assistance. And if you are able to, and for sure you are able to offer, better competitive prices for doing their tax returns. But that is more on a personal level. There is no specific website or IRS, sources which you can. So I hope that answers the question.
Yep, thank you very much. There's one more question I would like to ask. As an NRI, if I show 3 lakh income, 3 lakh rupees, and take refund in India, okay, then I have to anyway show that 3 lakhs or 300,000 rupees in Indian income tax on my tax residency. So, oh, sorry, the question is, I have to anyway show that 300,000 rupees Indian income in my tax resident country, whether, for example, in USA or no? Do we have to show or not?
Okay, I'll just add a little more assumptions to this question. So assuming that you are a US tax resident, maybe a US citizen, green card holder, and you have income in India worth 3 lakh rupees. So of course, if you are physically present in India at the time you earn this income, India has a right to tax you on that. But in US also you have to make a disclosure and file taxes on that in case the US taxes are higher than India, because what will happen is that once you show that income in the US, you are also able to get a foreign tax credit, whatever taxes you've paid in India. So if the taxes in India are lower than the taxes in the US, which is not likely because Indian taxes are slightly higher than the taxes in the US, but just for discussion purposes, in case the taxes in India are lower, then you have to pay the difference of those taxes on your US tax return.
So there's one more follow-up question which just came actually. If the earned
Okay.
income in US, I think the US people are on fire here, so so that's good. So if the earned income in US was sent to India, okay, for land to buy the land, and the amount was not more than $10,000 at any point of time in the account during the year, but the money you sent was 50,000 US dollars equivalent, do they still have to do the reporting in FBAR and FATCA in US?
Absolutely 100%. Because so FBAR is they will not have to, because FBAR is more relating to your financial assets. So real assets are disclosed on FATCA. Yes, because it will not be on how much you sent in a particular year. It is actually the total add up of that. So whichever year you buy that property, say you sent 10,000 each year for 5 years, and after fifth year you bought that land or property worth 50,000 US dollars. That's when you have to make the reporting. But until, if you are sending $10,000 every year to a bank account in India, that has to be reported on FBAR. But FATCA will come in only once you bought that asset, which exceeds that $50,000 threshold.
Thank you very much. So considering the time now, on the screen is displayed the contact details, email address, etc., of all the speakers and including moderator. So if you have any more questions, feel free to reach out. So having said that, I have to stop sharing now. And wait a second. I hope everybody has made a note. Did I stop? Yes, I think. So, so moving on to the closing. So thank you, the panel of speakers, very insightful, points and everything, information you gave, and taking the questions live. I know it's not that easy as it looks, but you guys have done a tremendous job. Thank you, everyone. So with that, thanking everybody. I think officially I should ask our chairperson, Purnima, to move to the vote of thanks. Thank you. Purnima, over to you.
Hello, everyone. Hope you all hear me.
Yes.
As we conclude this enlightening session, myself, Purnima Chaka, chairperson of ICAI Michigan Chapter, I feel it's my pleasure to deliver the vote of thanks for this special webinar that our chapter has had the honor of hosting. And to note that today is especially meaningful for us because this program marks Michigan's very first collaborative event with ICAI headquarters. It's a proud moment for us, a milestone that reflects our chapter's growth, presence, commitment, readiness to contribute to the global ICAI community. First and foremost, we express our deep gratitude to Ms. Anita Suneja, Joint Secretary ICAI, for her constant support and guidance in making such international collaborations possible. On behalf of entire Michigan chapter, I extend my heartfelt gratitude to CA Preeti Parasalva, Vice Chair.
Yeah, please keep on going.
Need to
I
unmute.
think your voice, I think you got muted somehow. Purnima?
Am I audible now?
Yes.
Yeah,
Yes.
no.
On behalf of entire Michigan chapter, I extend my heartfelt gratitude to CA Preeti Parasalva, the Vice Chair of Member of Industry and Business Committee, for inaugurating today's session with such a clarity and purpose. Our sincere appreciation to CA Anuj Goyal, Chairman of Committee, for his inspiring keynotes and guiding initiative that empowers members in industry and business across the globe. We are grateful for the trust and support extended to Michigan chapter in conducting the program. I very much thank you for the advice and the initiative you got. Anuji, the industry-driven CPE credits circles. Once we move to overseas, it is something that we all needed. And a warm and special thanks to our distinguished speakers, CA Kulvinder Makar, CA Siddharth Goyal, and Mr. Rajiv Ahujaji, for sharing deep insights on immigration dynamics, NRI compliance, and FEMA regulations, have provided our members with invaluable clarity on complex cross-border challenges. Your perspective have added tremendous value to our members navigating global presence landscapes. I would also like to acknowledge the visionary leadership of CA Prasanna Kumar D, President of ICAI, and Mangesh Kinera, Vice President of ICAI, whose commitment to the global provision excellence continues to inspire us. My appreciation to our moderator, CA Siddhant Goyal, Director of Michigan Chapter, for steering this session seamlessly and ensuring an engaging discourse. Not only he did the steering to this session seamlessly, but he also been the driving force behind the scenes, coordinating tirelessly with the headquarters, aligning speakers, managing the technical flow, and ensuring the every event come together smoothly for Michigan Chapter. His dedication, calm leadership, and behind-the-screen efforts are truly commendable, and today's success reflects his commitment. To all our attendees joining from North America, India, and all around the world, thank you for your active participation. Your engagement is what motivates us, and a Michigan Chapter to continue bringing meaningful and relevant programs to all our global ICAI community. Finally, my heartfelt thanks to the organizing teams at headquarters ICAI and our own Michigan team volunteers. Your dedication, coordination, and behind the screens efforts made this event smooth, timeless, and impactful. Thanks once again for joining us today. We look forward to welcoming you to many more initiatives hosted by ICAI Michigan Chapter.
Thank you, Purnima. Thank you. Just one more thing, one more important name I would like to mention is Purva. She's been really, tirelessly like waking up at 4 o'clock to match my schedule. I'm also doing a little bit, but she's doing more. So thank you, Purva. Without you, this would not have been possible. Thank you very much. And with that, on that note, two unstructured CP hours will be uploaded for the eligible members who have registered with the membership for the session. And thank you very much, and looking for much more sessions to come. Thank you. Thanks, everyone.
Thank
Thank
you,
you, everyone.
Siddhant. Thank you, Purva. Thank you, Anita ji.
Thank
Thank
you,
you.
Siddhant. Thank you,
Thank you,
Purnima.
Purnima.
Thank you, Rajiv
Thank
ji
you,
and Kulvinder,
Siddharth.
for
Thank
the
you, Anand ji.
fantastic discussion. Yeah.
Yeah,
Yes,
sure.
thank you.
Thank you. Thanks, everyone. Bye.
Thank you, everyone. Thank you. Bye-bye.